You're listening to How India's Economy Works, hosted by journalist and author Puja Mehra.
Hello, I'm Puja Mehra. Do you know that the first private bank in India was set up in the 1700s? For hundreds of years, private banks operated in India and failed and folded up, often failing to return depositors their money. That's because there were hardly any rules or regulations until the RBI was set up, which happened only 90 years ago. Even after the RBI started regulating private banks, they did not become fully safe for depositors for a long time. In fact, even today, that task remains incomplete. My guest today is Dr. Amol Agrawal. He's the author of History of Private Banking in South Canara District, 1906 to 69. Amol teaches economics and public policy at Ahmedabad University. His blog, Mostly Economics, has been in the top 100 economics blogs of the world. In today's conversation, Amol takes us through the fascinating journey of private banks in India from the 1700s to now. Hi, Amol. Thank you for coming on the show. I'm very excited about our conversation about private banks today. You were telling me earlier that the history of private banks in India goes back to the 1700s. So tell us about the private sector banks we had in India way back in the 1700s.
Yeah, so the private sector banks, as we know today, were very differently organized as we trace the history of banking in India. So the first kind of bank we have some records, RBI has some stuff, is in 1770, Bank of Hindustan. This is just after Battle of Plassey is over and the British are getting some handle of the country. There's some discussion on setting up some banks in Madras, but we don't really have records, so we stick to 1770. That's where Bank of Hindustan comes up. So these British, they realize that unlike other colonies, India is already population. There are things the British can sell. So as commerce expands, you need some banks, some financial organizations. So that's what leads them to set up agency banks as we understand it. Even before, as the British start coming in, we have these indigenous banks and the money lenders, which is already there, which is also some sort of a private money lending system. But we are not really going there because different kind of a history. So 1770 is where the first kind of these banks come up around Calcutta. And then we have the Battle of Mysore, battling with Tipu Sultan in 1799, where the British realize that they need finances to fight wars. So that's what leads to the first set of presidency banks, started in 1806. And then you have 1840 in Bombay and 1843 in Madras. The presidency banks, initially, the idea was that they will be privately owned, but East India Company had to buy some stake. So one doesn't know how do you classify these banks, but so the way Indian banking system is classified, these presidency banks are classified differently than the other banks which are setting up. So as Calcutta becomes a major center, a lot of banks start coming up in Calcutta. Dwarkanath Tagore, Rabindranath Tagore's grandfather, set up a Union Bank with two British partners. And this bank, the Tagores are trying to challenge the presidency bank. But the commodity business in which they invest in is a very volatile business. So a lot of these stories, keep coming back. Commodities and banks and banks lending, whether it's a private bank or a public bank. So a lot of exposure to these commodities means that these banks fail. Then you have Bombay starting to shape up. So the Presidency Bank of Bombay comes up. 1860s, 1861, we have the Civil War, American Civil War. And at that time, by then the first railways had come up. The British were thinking seriously about exporting raw cotton, using the railways, exporting raw cotton to England. And as the Civil War happens, these things are happening, and suddenly the supply from America stops. So again, because of this cotton thing, cotton starts to move from Bombay, and a lot of banks come up in Bombay. What I'm trying to tell you is that, as we keep reading about a couple of years ago, there were these large-scale bank failures. So there's a lot of history as far as private banks and failures are concerned. 1865 is when you have first kind of bank, which we know today, Allahabad Bank, continues to exist. So it was merged in the great public sector bank merger in 2018.
There's the Union Bank of India.
There have been quite a few, I think 2 or 3 union banks. The Union Bank which exists today was set up in 1990. The Tagore Bank closed down in 1840 as several of these Calcutta-based banks closed down. And just like 1860, several Bombay-based banks closed down.
Also, Amol, before you tell us about the rest of the banks between the 1800s and independence in 1947, we know that RBI is just about 80 odd years old or so. So there was no RBI or any regulator at the time that you were talking about. How was Indian banking regulated? Who was safeguarding the deposits that they were collecting from people? And who were the people who were putting their money in these banks in the absence of any safeguards? Tell us a bit about, the everyday working of these banks.
Yeah, so at that time, we didn't really have any regulators. As you rightly said, RBI came up in 1935, 90 years old. But at that time, the basic regulating body or regulating law was the Indian Companies Act, which did not really specify banking particularly in the beginning. But then there were amendments and banks were included as companies. So basically, you had registrars in different regions which were supposed to be looking at these banks, but nobody really paid attention to the banks. That's what I said, that there were large scale banking failures and there was nobody really looking at them. The depositors, largely, there were few rich Indian merchants, largely British, who were using these banks to basically finance their businesses. Again, the major initiative as far as Indian banks are concerned, as far as so far, much of the banking system is mainly in the hands of the British. Indian sort of stuff starts to come in 1894 with Punjab National Bank coming in, set up in Lahore. You have some very prominent Indian nationalists who were Punjabi nationalists who were part of this bank. And then you have the Bengal partition in 1905, where again, there's this major movement towards Swadesi capital, Swadesi businesses, and that's where, Swadesi banks typically come up. But then as these Swadesi banks come up, you have these problems of too many of these entities coming up again, and several of these banks fail. Now, the question you popped up about the regulation, the first time the British really started paying attention, and largely because of bank failures was in 1912, is when they realized that, look, this banking failures are becoming too much and it is leading to loss of revenue. By the time Indian economy or the colonial economy is sort of getting more mainstream, there is more trading, more stuff going on. The Indian nationalists have set up large number of banks, especially around Punjab area. So once these banks fail in Punjab is when they wake up, and 1913 is when you first time start collecting information about banks. So that's a publication called Statistical Tables Related to Banks in India, which exists still today. I mean, that's a tradition we've carried forward from 1913. In 1913, what they also do is that they take the data back to 1870. So from 1870, you have some information about the number of banks, the deposits, and so on and so forth. So it gives you some sense of the kind of banking activities happening.
But in this, if there is a bank failure or a bank's fraud, the depositors have no recourse. And the owners or the management of the bank, they basically go scot-free, is it?
Pretty much, yes. I mean, that's the reason why the British suddenly got worried, because so far, I think it was largely the merchants and so on and so forth who were depositing money. So you didn't really care much. But by then, this Swadesi movement, this nationalist movement had picked up. So you also had certain people who had invested into the were given deposits and so on. So there was this general concern. And then we fast forward to RBI in 1935. Once the RBI comes there, it takes over this publication, the banking publication. The RBI history is a very glorified, very interesting history of how it really comes up. It's set up as a shareholder private bank. And then the Reserve Bank of India, very quickly as it's set up in 1935, at that time, the focus was mainly on monetary stability, on the currency management, not so much about banking stability, ironically. And 1938 is when RBI meets its first major bank run, called National Colon Bank. And at that time, RBI decides that we need a separate banking regulation act because the banking system in India had become too diverse. So till RBI comes in, you had the presidency banks, and the 1913 publication divided the other Indian banks into A category banks and B category banks. A category banks are banks which have capital more than 5 lakhs, and B category banks are banks which are less than 5 lakhs. When RBI comes in, it realizes that less than 5 lakhs is also, there's a lot of quality difference. So RBI says that, so firstly, the A category banks, also there's a difference. So now after post RBI, you had to be a part of the RBI schedule. The RBI Act has a schedule where all these banks were licensed or all these banks were categorized. So the A1 category banks were the ones which RBI realized, RBI said that these are the banks which would be included in the schedule. A2 banks had more than 5 lakhs capital, but they necessarily did not have the right banking practices. And so you had B category banks which had capital of 1 lakh to 5 lakhs, C category banks from 50 lakhs, 50,000 to 1 lakh, and D category banks, 50,000 and below. What's interesting is that once RBI comes to the system, the number of banks which we were looking at suddenly expands from 100 odd banks till RBI to close to 600, 700 banks, because the number of D category banks or C category banks were not included earlier. So the RBI realizes that there's a lot of problems as far as banking is concerned in India. Even though in 1938 bank failure happened, then you had partition, you had independent movement, Second World War. So it takes about 10 years till this Bank Regulation Act post-independence is enacted. And that's when RBI starts to get into the show properly as far as regulating and understanding banking is concerned. So RBI starts to clean up the banking system, and 1955, a major decision is taken where the three presidency banks were earlier merged into Imperial Bank in 1921, and that becomes State Bank. Before State Bank is nationalized, RBI is nationalized in 1949. So there is a lot of discussion going on in this period around the way you want to look at banking and the way you want to look at financial resources, because planning has as an activity that you wanted things under the government control. But so far, they said that, okay, we just nationalized one major bank, and then they didn't really look at other banks. But very interestingly, another bank failure happens again in Kerala in 1960. So Kerala has a very interesting history. I mean, though we understand Kerala as a communist state and so on and so forth, but it had a fairly interesting capitalist traditions, especially if you look at the number of banks. A lot of these banks came out of chit funds. That's another history of its own. So many chit funds come up in Kerala. And so this 1960 Palais Central Bank failure happens. That really shakes up RBI quite a bit, because now RBI did not have the excuse that you didn't have a regulation act. You had a regulation act. RBI gave them a lot of time. The Palais Central Bank sort out their problems, but that didn't happen. So the Palais Central Bank failure shakes up the banking system. A lot of deposit problems happen. Until then, you didn't really have a system wherein deposits would be. The way this would work is that this will go as a company, and the law will sit on it and try and recover how much the depositors can get. And in the Palais Central Bank case, it took a long time. So parallelly, RBI worked around this problem, and today, whatever reorganization, each time a bank fails, RBI puts it under moratorium. All that RBI worked out in the 1960s. What RBI also, along with the RBI and the government, they enacted the deposit insurance, which stalled all these bank runs in Kerala-based banks at that time. And then 69 happens. Now 69 happens, 69 changes the color of Indian banking completely, in the sense that all this while you had the State Bank of India and you had the private banks. Now you have State Bank of India, nationalized banks, and private banks. In nationalization, what the government does is that it nationalizes 14 largest banks. And there are great accounts of IG Patel and some others. So there are all these accounts of these guys who kind of documented and how randomly you chose a 50 crore deposit number. The banks having deposits greater than 50 crores, they were nationalized, which meant 14 banks were nationalized, and these were the best run banks. The nationalization breaks the banking classification again from A, B, C, D private banks to just the SBI, nationalized banks, and the scheduled banks. By then, most of these banks which were outside the schedule, RBI had tried to clean them and tried to bring them as part of it. So there's a lot of action RBI did behind the background, where you cleaned up the banking system and you really tried to put it on some kind of a footing, because there were a lot of irregular banking practices. There were companies which you could just open a bank. Before RBI came in, anybody could be a bank, anybody could be a banker. So RBI had to, even to define a bank, that definition didn't exist. So RBI had to define a bank, right? I mean, all these regulatory changes, or each time you bring regulations, it's very difficult to define these terms. So how do you define a bank? RBI gave that banking definition, and then you did a cleanup exercise. You realize that only those entities which are doing activities similar to what the definition says will be allowed to call themselves a bank. You could call yourself a banker. So all these things at a pan-India level were very, very difficult.
Amol, the sense I get is that you're saying that at the time of nationalization of some of the largest private banks, 14 largest banks, there was probably a case for the other not so well-run banks to be nationalized rather than the better-run banks to be nationalized. So was it a case of selecting the wrong banks for the right policy? Is that the point you're making?
No, I mean, the point I'm making is that, nationalization was done in a very sort of a very interesting strategically, the way Indira Gandhi and did nationalization was a very interesting thing. But when it comes to the criteria for nationalizing, which bank should be nationalized, the discussions lead us to the fact that she didn't think much about it at that time, and she just gave it to her bureaucrats to think about it, and then they came up with a 50 crore sort of a figure. What is very interesting is that the purpose of nationalization, obviously, there is an intended purpose and unintended purpose. Intended purpose is that you wanted to basically provide financial inclusion through the banking system. You wanted to give more loans to the agriculture, small, medium enterprises. The banks were not really going rural, and the branches in rural areas were very limited. So Indira Gandhi, that was the intended way, but there were all these unintended things that she wanted to use and nationalization as a way to get political power. Congress had lost elections. She was not seen as a very powerful leader. So all that taken aside, and then obviously large number of industrialists, despite RBI coming in, large number of industrialists still control the banking system. So by nationalizing, you wanted to take away that thing from these big businesses to government.
You wanted to democratize credits, listening, flow of credit. Are you saying that although she did it with a political bent of mind for very personal reasons, but you're saying there may be some economic argument for it also?
No, there is. Definitely, because in the next 10 years, the banking landscape changes completely. The number of rural branches in the whole banking system were about 15% or 14% before nationalization. In the next 10 years, about 66%, 67% branches are all rural. Now, I don't know whether that's a good thing or a bad thing, but essentially, a lot of people got banking services with nationalization, especially in the rural areas. Now, one can always argue we don't have a counterfactual. My point was that if you had to nationalize banks based on the inclusion criteria, there were some banks, especially in my own research on South Canara Bank, suggests that these banks are already doing financial inclusion. You didn't really have to nationalize them. I mean, you would have had a very interesting counterfactual where these South Canara banks were allowed to do things on their own and compete with all these nationalized banks, and then you could have compared that who did a better job, nationalized banks or the South Canara banks.
And when you're trying to nationalize, you obviously want to go for the fattest cats, right? You don't want to go for the ones where you have to do the hard work of cleaning up those banks. And so you end up with good private sector banks now operating as nationalized banks, and you also have on the side the not so well run private banks continuing to be private sector banks, and I'm assuming continuing to not be run well. Is that right?
Yeah, so actually, a lot of things change. Suddenly, Central Bank of India, which was a very interesting bank, which was almost competing with State Bank of India at some point in the 1950s, suddenly completely loses out. Today, Central Bank of India, we'll come to that topic later. But likewise, the South Canara banks, the history is completely lost. So obviously, the nationalization created its own benefit. As I.G. Patel says that maybe for 10 years, nationalized banks did a great job in terms of reaching out where nobody imagined one could reach out. But at the same time, I think every policy has a shelf life. And maybe after 10, 12 years, these banks continue to, became even more handmaiden of the government, pushing government policies, not just inclusion, but all kinds of government propaganda.
And since your research is in these banks, Amol, I wanted to also ask you, was it at all an option for the government to, because they in the 50s and 40s, they had set up so many PSUs. Was there a case for them to set up a PSU bank instead of just, nationalizing a private bank? Could they have just set up a bank?
They did set up DFIs. They did set up Industrial Financial Corporation of India. Then they set up ICICI Bank. Then they also tried to bring cooperative banking system into the fold, that the commercial banks can basically do the industrial lending, and the cooperative banks will basically go out and provide financial inclusion. But cooperative banks, because of the limited size, did not really reach out in that big way. They were much more limited. Yes, those questions do come in, that, whether it was a good idea to set up a new public sector bank or new system of public sector banks. But I think they went for development financial institutions, as we call them today, and hoped that they would do the job, but not really look at setting up retail banks as public sector banks. Understanding was that we'll take over these existing banks and convert them to nationalized banks. I think it's an interesting question to look at.
And then in the 1990s, we see private sector banks getting set up when Dr. Manmohan Singh is the finance minister, right? And those are the sort of the real success story, I suppose, of Indian banking sector, especially private sector banks. So tell us that story.
So from 1770 till about next 200 years, you have bouts of a large number of private sector banks coming in, closing, failing. And, it was a fairly interesting phase for Indian banking. And the next, from 69 to 1991, there is absolute stall in private sector activity. There is no new private sector bank which comes up. Just to look at some numbers, when you look at 1969, you had total 72 banks. You had SBI, you had nationalized banks, you had 36 private banks, and 14 were non-scheduled banks, which were not really part of the RBI schedule as of now. And by 1991, the number of private banks had come down to from 36 to 24, and the number of overall banks had declined from 72 to 52. And much of the banking system is basically public sector. About 90% of deposit, 90% of loans, and so on are with the public sector. Now, we just discussed in 1969, there was another nationalization phase in 1980 where 6 more banks were nationalized. So overall, most of the banking system was in the public sector space. 1991, Manmohan Singh comes in and as a finance minister, and even Narasimha Rao, the prime minister, and they decide to reform the economy under the famous 1991 reforms. And one of the major plank is financial sector reforms. You set up a very interesting committee under M. Narasimhan, who is obviously been with the RBI for a long time, understands the space, and sets up, I think, one of the most interesting documents on Indian banking history is M. Narasimhan Committee Report, where he lays out a very interesting framework for the entire financial system, of which banking is the major component. And there you say that government should give more license to the new private sector banks because banking technology, banking regulations, a lot of things had changed, and Indian banking had not really kept pace. And by the 1990s, even the Indian banking public sector banks were making large-scale losses because loan melas, a lot of problems. As I said, 1970s, it was all okay. 1980s is where a lot of problems are there in the banking system as well. In 1990s, the RBI starts to look at new banks. The RBI's history suggests some 140 applications came in for setting up new banks, and then RBI vetted all of them. Finally, it gave license to 10 of them, which became the HDFC, ICICI Bank, IDBI Bank, Axis Bank. So Axis Bank at that time was UTI. What is interesting is that it was a combination where you had these existing financial institutions like HDFC would set up an HDFC Bank, ICICI would set up an ICICI Bank, a UTI would set up a UTI Bank. And then you also had Centurion Bank, you had Bank of Punjab. There was some 10 odd bank licenses which were given at that time. And gradually, these private sector banks with their new age technology and no legacy of priority sector loans or any of those problems, they started performing, and the 1991 reform started kicking in. A new sort of consumer class is created. And these banks give you these new age technologies, the ATMs, those things nobody had imagined. And very quickly, you could open a bank account. I remember just sort of going in and giving a passport or something like that, and you could just open a bank account. It was that easy. So a lot of these benefits started coming in, and the entire space changes. But again, there is a slight blip because the number of licenses RBI gets, they don't really stand up. You have problems with Centurion Bank, Bank of Punjab, and then obviously the famous bank failure of the Global Trust. So the Global Trust Bank came up, it really rose very quickly, and then it was found majorly in the Ketan Parekh scam involved, and then the bank declined sharply, leading to a major loss for the Reserve Bank of India, which gave licenses to these. And Global Trust Bank was given to professionals. So unlike as I said, UTI or where you had institutions, so Global Trust Bank failed. And where I think this is some memory which still sticks with RBI, because after this, RBI is very slow and very cautious in giving licenses to new banks. After that, you just have 4 major banks coming up. One is Kotak, Yes Bank. Yes Bank declined, and then you have Bandhan Bank and IDFC. So you gave 10 major bank licenses in one go in 1994, and that experience is not great because of those 10, Centurion Bank is no more, Bank of Punjab is no more, and there are 2 more banks. So basically, the experience is not great. And then you have this major Global Trust Bank failure. So which leads RBI to be very cautious in giving bank licenses. And then the Yes Bank failure in 2020 really leads to a lot of problems because Yes Bank was seen as a bank which was doing really well. A lot of good things were written about the bank. And then suddenly you realize that the story is the same, in the sense that each time you see any particular bank or couple of banks getting too adventurous and that bank balance sheets expanding significantly. So if you look at Kotak, right, and Kotak and Yes Bank, which are giving bank license at the same time, Kotak pretty much is like a snail, almost a flat line over 20 years. And Yes Bank is like a jet plane taking off. And then you know that something is going wrong, because how is it that Kotak is growing so slowly and so cautiously, whereas Yes Bank is. So there were, I think, some signs already there, but it's just that, unfortunately, just like we saw in the case of Palais Central Bank, that RBI gave a lot of time to the owners to work on their problems. You gave a similar time to Yes Bank, but then they didn't really find their ways. So I think several ways history repeats itself.
That brings me to the question, Amol, that what is it about banking and privately owned banks that since 1770 till now, when we had a regulator, when we did not have a regulator, how is it that this cycle keeps repeating itself? What is it about banking that makes it so vulnerable?
As kids, you are told all these stories about Vedas or King Vedas, or all these stories where you think that you've got this thing to make money very quickly, and you think that you've conquered this problem, which is a problem for most. That how do you make money so quickly, and you've kind of figured it out. And each time the banks or the bankers think of it that way, and you have a problem where you think that you can grow very quickly, and so it's all this. These stories keep repeating because of this thing of try to grow too quickly too soon. And then obviously sometimes you do have the commodity cycle or some business cycle which goes the other way. Before the regulations, at that time, banking practices were not really understood very well. Post 1935, when RBI comes in and Bank Regulation Act comes in, I think we understand these things relatively better. But then we are humbled each time. I mean, who could have imagined in 2008 so many global banks failing? 2023, you had Credit Suisse failing, iconic Swiss bank. So again, I think though we think we know quite a bit as to how to run these banks successfully, we always fall short, especially if there's a thinking that you can grow quickly and you've understood the systems well and you've understood things well. So if you overstretch yourself, your leverage ratios are very high. Most of the time, those stories go badly. But then we've also seen the case of Kotak, a very interesting thing of Uday Kotak not wanting to go, and there have been some governance issues. So again, I mean, it's not easy. Banking has never been an easy subject.
Elaborate on what you were saying, Kotak, because many of my listeners may not know about it.
Yeah, so there were these issues that RBI wanted Uday Kotak to resign or to kind of leave the bank as he was reaching the retirement age, and Uday was not keen. I mean, we saw a similar episode with HDFC Bank also. So it's not really the case. There is this, we've had these waves that public sector banks were deeply criticized after the 1991 reforms, especially because as you got more options, more opportunities to bank with other organizations, the public sector banks were not really seen up to the mark. But then we've seen even with private sector banks that the governance and so many issues have come up. But ICICI Bank had been bailed out by RBI in 2008 crisis. If RBI did not come up with an assurance at that time, one doesn't know.
I recall you're talking about ICICI Bank. I recall that, in fact, the finance minister, I think it must be the first time in history, Finance Minister Dambram made it public that the RBI was reluctant. The governor at that time was Dr. Subbarao. The RBI was reluctant to come out and say anything assuring people who were queuing up at ATMs to withdraw money. There was a run on ICICI Bank. And there was a reluctance on the part of RBI to come out and say that no, all is fine with ICICI Bank. And Mr. Chidambaram, after waiting for a long time, he just decided himself just go and say it. And it's after, I think, he gave the assurance publicly. That's when RBI also issued an assurance. And that sort of really helped ICICI Bank. Otherwise, it would have had a liability mismatch. The thing with the bank is, once there's a rumor or there's a lack of confidence and people start queuing up to withdraw, then there's really nothing much that even a good bank can do, right? So I think that makes banks especially vulnerable.
Your assets are tied up into long-term loans, right? If I've taken a deposit or if I've invested money in a bank, I want that immediately. I mean, if there's a problem. But the bank can't recover that money very quickly because, let's say, simultaneously I've taken a loan from that bank or some other bank. It's not as if the bank will ask me to sell the home and give the money. So banking is all about trust. It takes years and years and years to build that trust. And in very little time, that trust goes away. Because as depositors, that's a promise the bank makes that each time you want your money back, we'll give it back to you.
Banking and financial markets don't really run on money, they run on trust. The day the trust goes, everything collapses, which is what happened also in the global financial crisis, that everything sort of freezes. But you've given us, Amol, a good sense of both the history, busted some myths, popular myths about banking sector, also told us how vulnerable banking sector tends to be. But I also want you to now tell me a bit about how important banking is, what role banking has played in the growth of our economy, and how important it is to get banking right for an economy.
Very interesting question because a lot of banking research happens on the role of banks in an economy. And again, the way we look at it is that an economy has two legs. One is the real economy leg, one is the financial economy leg, and you need the both these legs to work together. And finance pretty much provides much of the lubricant for the economy to run. And the question is how this finance should come. Should it come through the banking system or should it come through the capital market system? In the United States, the capital market system has played a very important role, much more than the banking system. Whereas most other economies, the banks have played a larger role for historical and political reasons. So obviously, the banking system is very important. We've sort of seen this with multiple crises all around the world, that a banking crisis, firstly, it takes time for the crisis to shape up. And when it shapes up, and it creates a lot of problems because it's not just failure of one bank, but several other banks are also under problem because people very quickly compare that, if this is a bank which is failing, what is the likelihood of the other bank failing? With the Palais Central Bank, several other banks failed largely because people thought that if Palais Central Bank can fail, and we saw that with Yes Bank also, that there was runs on some of these Yes Bank sized banks, people are not sure of. Banking system is very important. It has played a very important role, and banking activity has to run in a proper way. And I think what is very important is training bankers is very important. Just a couple of days back, Mr. N. Bagul passed away, eminent banker of ICICI. And it's amazing to read the tributes where so many people have chipped in and pointed out how he personally was a great banker and he trained so many bankers of today. I mean, so many people. And, likewise, when the new private sector banks came up in the 1990s, a lot of human resources came from the public sector banks. So again, I think there's something fashionable about finance. Most people who do MBA finance or do economics and finance, is thinking that you can go rich quickly and one can easily make money. I think those myths have to be demystified and dispelled completely, saying that this is a very hardworking activity. One has to be very careful, has to do a good job of running proper banks because at the end of the day, it's a human endeavor. It's all trust based.
Amal, in the last 4-5 minutes of the show, I want you to discuss ICICI Bank and HDFC Bank. ICICI Bank, which has seen highs and lows, again related to individuals. If you could just take us through the story of how it was doing very well, and there was this whole concern about Videocon and ICICI Bank, and then HDFC Bank, which is doing very well. It is the world's most valuable bank, and how there is a merger to be done with HDFC, and there have been recently been hearing some concerns about that. So the story of ICICI Bank and the story of HDFC Bank.
Right. So ICICI Bank both these banks came up together, and ICICI Bank had a very interesting person, KV Kamath, was initially there at the bank, and he really helmed the bank. The bank grew very quickly. It innovated in very interesting ways. A lot of auto loans, farm loans, consumer loans, a lot of things came from ICICI Bank very quickly. The balance sheet grew. HDFC all this while was a very slow and steady bank. They had all the technology, all the things, but Aditya Puri was never really too much into personality. One never really saw any interviews. And HDFC primarily has always been around retail, focusing on consumers, very slow and steady. Whereas ICICI Bank was always very interested in which sector is growing and what can I do to look at that sector. And 2008 crisis was a major turning point in the history of ICICI Bank. And after that, you had Chanda Kochar. One doesn't want to get into that, but some very unfortunate decisions were taken. And after that, ICICI Bank is pretty much away from the limelight. One doesn't really hear much. They have done a fairly interesting job of completely depersonalizing the bank. The bank was much more a personal thing earlier, along with the institution, obviously. But interestingly, what happens is that all these stories are there for a timeline. I mean, HDFC Bank, which was a very unpersonal thing, became a very personal thing where Aditya Puri, suddenly we realized that, HDFC Bank has an Aditya Puri risk. If Aditya Puri goes, what happens? And for a long time, HDFC did not really plan very well for who's going to take over. And then very quickly, RBI was all the time raising the retirement age. And then gradually, RBI said, no, enough is enough, you have to go. And then very quickly, HDFC had to appoint somebody else to take over after Aditya Puri. And, it's also interesting that times change. I mean, our generation, our parents' generation, which banked with SBI, we banked with ICICI, HDFC. But the young generation doesn't care at all about these banks, right? I mean, their ways of transacting and the ways I look at students all the time and the way they look at banking and the way they look at finance is very different. They don't really look forward to it to a branch. So whichever organization is giving them the seamless experience of just transferring funds from the mobile is what attracts them. I mean, and they don't have any history or any such brand value to HDFC or ICICI. So obviously, the technology things which HDFC should have done, I mean, HDFC didn't really pay much attention to improving its technology, and there were some questions about if you're transferring funds or app going down. I mean, those are things which HDFC didn't understand. And I think that's, again, a humbling experience, right? I mean, you were the leaders of technology in your time in the 1990s, but now there are some other players who are doing a much better job, especially for the young generation and the generation which has grown into a very different sort of stuff. So very interesting. I mean, and today ICICI is kind of, as you said, ICICI is just completely not there in the news at all. HDFC continues to make news for all the wrong reasons. Firstly, with the technology thing and this merger coming in, it's going to take time because you've taken a massive HDFC organization balance sheet onto your balance sheet into a time where you are supposed to be very nimble. Right? You're supposed to be much quicker. You're supposed to make those technology changes much quickly because, as I said, the young generation doesn't really care. I mean, this is the future. We might still be okay with banking with these organizations. At a time when HDFC should have been nimbler, it has been slowed down because of the merger decision. So we'll have to wait and watch how this pans out. On ICICI Bank, I think it is just doing an interesting job. It is doing a very fine job, completely away from the limelight. ICICI Bank is sort of become interesting institution, completely non-personalized. We don't know with HDFC Bank what direction it takes.
Right. Thank you. Thank you so much for taking us through the journey of Indian private banking, Amol. Thanks a lot.
Thank you. Thank you. Always a pleasure.
After recording this conversation, I feel that I should invite Amol again to the show for follow-up episodes in which I would like him to explain in detail the various phases he told us about today. There's so much more to the private bank story. I'm glad that Amol has agreed to return to the show to tell it. Can't wait.
You've been listening to How India's Economy Works, hosted by journalist and author Puja Mehra. Do stay connected with more of our coverage at The Core. You can check out our website or sign up to our newsletter at www.thecore.in. That is www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback, so do write to us at feedback@thecore.in. Thank you for listening.